From Barangaroo Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
Good afternoon, if I can call it that. This is the COB. My name's Carl Orr. I'm with Danny Akuye, and the reason why I say if you can call it that is because it's been a pretty rough day out there.
It has indeed. Looks like the ASX 200 is down about 108 points, 1.5%. So 7,196. And it was pretty grim out there, wasn't it? The tech stocks.
Yeah, absolutely. It was off by 1.4% by the end of the day's trade there, the CBO 200. So looking fairly weak indeed. And let's just get across some of the sectors now that were weighing on the market overall, starting off with the tech space. Tech stocks down collectively across the board. WiseTech Global pulling back by 4%, Xero down to $116 a share, which it hasn't traded at for a couple of months. Block also off. A bit of an interest rate story there actually. Some strong US data last night, putting some upward pressure on rates. Obviously not good for growth stocks, but well, there could have been a bit of a double whammy for the growth and value sort of factors today, because if you look at the material space, which we will now.
That was pretty grim too, wasn't it?
Yeah, that China story hasn't, it's sort of fizzled out again, it would seem.
Yep.
Well, BHP reports in a week's time, but it was off 3% today.
Indeed, and probably not surprising given all the problems going on at China at the moment.
Yeah,
I feel like there's a lot more to run when it comes to emerging markets if treasuries continue to tick up.
Yeah, there's calls of potential balance sheet recessions and maybe policymakers not addressing the actual true issues at hand when it comes to China. Kind of sapping the confidence here about the prospects of a recovery. So again, hit from multiple angles today. That's the miners. Banks as well, also faring fairly poorly. CBA was ex-div.
$2.40 and 100% franked.
There you go.
Yep.
Are you a holder? Yep, I suppose we all are indirectly, aren't we? If you have superannuation funds, you've probably got it somewhere. But nevertheless, that's why we saw the 3.7% drop in CBA, but also weakness across the board in the banks. We have a few more quarterly updates rolling through in the next few days from some of those players. So very weak across the board. But Danny, let's get to the three themes.
Absolutely, let's go to the three themes.
I think the kind of, in a nutshell, if you will, the market has been hit on all angles today. There hasn't really been that much good news at all. Retail sales surge, that was the United States. It looks like the consumer is just in a very strong position at the moment in the United States, and that raises, obviously the risks that the Fed will either have to move rates higher or at the very least keep rates high for longer. Yeah,
but they're also racking up a ton of debt. Right. Absolute ton of debt. So it's not actually a case of there's more cash, but they are actually increasing their credit card debt. So a lot of US commentators have been basically saying, the banks will decide when they've had enough of that. And obviously the banks are potentially under pressure because Fitch has flagged that they may be looking to downgrade the US banks.
Interesting. I was thinking that too, because I know with one of the guests before, you were talking about how obviously the structure of their mortgage market's a lot different. They have these 30-year loans that, if you did take out a mortgage in the last, say, 3 years or so, you're paying 2% or whatever.
Yep.
It means your borrowing capacity is so much stronger than it would be otherwise if you're on a variable rate. So you can take out these loans if you want to and contribute, that demand into the economy. It's kind of a second order effect that kind of complicates the job of the Fed, whose transmission mechanism is very different to that of the RBA's.
Yeah, so with their new homes market, the builders are actually providing subsidised mortgages at the moment.
As well.
Yeah, so that's what they're doing because the mortgage rate is 7 or 8% for a new mortgage. But again, I go back to a lot of people over in the States now, for any discretionary major items, cars, etc., they're having to borrow and the cost has gone up substantially. So I don't know, I think there are signs that it will slow down. I mean, you've got holidays, August holidays. I think it's going to be more telling as we head into autumn/winter in the US personally.
Always complex, of course. So that's the US story. China story might be slightly more simple just because it seems so dreadful. We'll speak about that a little bit more as well. And we have obviously done already, but reporting season, and that takes us to the flood of results that we received today. Let's just smash through them, shall we? Because we want to get across them all. Seven West Media, first and foremost, full year net profit, $145.7 million. Revenues, I guess that's slightly below expectations. I don't know if that's a year prior. No dividend declared though.
Yeah, that's never a good sign. No dividend. Nobody likes that one for sure. And then we should be, basically early trading indicates underlying revenue tracking full year 23 trend, targeting over 40% total revenue share, total TV market expected to stabilise during Q2 and optimistic for full year 24 and beyond. Wow.
Yeah, well, there you go. So there's 7. Moving on now, Transurban reported today, and I guess the story there, in fact, I think it was brought up on the call today, or it might have been some analysis done from a guest talking about obviously
slightly weaker than expected. That's what I picked up. Yeah, right. But they very much put a lot of capital in to fund that final dividend of 31.5 cents a share. But net profit, nevertheless, up 211% to 64 million. Toll revenues up 26% to 3.3 billion. Yet another case of where you see in inflation hitting the consumer's hip pocket, and free cash flows up 13%. And of course, Scott Charlton has left. Michelle Jabloko appointed CEO, and yes, it'll be interesting to see who the new CFO is.
Yeah, so there's Transurban's results there for you. Okay, this one was one of the laggards of the day. We'll see that in a moment's time when we go through the leaders and laggards. But Fletcher Building, full year net profits were basically cut in half. Flat revenues, costs the issue. So its shares were really smoked throughout the session. It was down 6 or 7%. We did speak to, I think it was the CEO, Nadine did, throughout the day. So if you're interested in getting some colour on the results, there's that there on your platform. But the outperformer, inexplicably perhaps, Bapcor.
Yeah, comes on the back of a GUD yesterday, which was one of the top performers. Net profit down 15% to 106.5 million. Revenues up 9.7% to 2 billion. Final dividend 11.5 cents a share. See solid underlying full year 24 performance. Again, a company that went into it downgrading. So solid trade demand to continue, trade market growth rate to return to normal, and retail segment to face ongoing challenges.
And that share was up today, so we'll again note that once we get to leaders and laggards, but one of the better stories of the day perhaps. Moving on, Mirvac also in focus. Full year net loss of 165 mil, operating profit down 3% on revenues that have fallen 31%. Total distribution 10.5 cents per share. And next one that we've got on the table, Vicinity Centres, staying, I suppose, in that space really. Also seeing a fairly significant decline.
Retail malls. So net profit down 78% to 271.5 million. FFO, it's kind of like the distribution.
Funds from operations,
That's
I think
it.
it is
Funds
now.
from operations up 15% to 684.8 million. Revenue up 8% to 1.27 billion, and a final dividend of 6.25 cents per share.
And net wealth, I had the privilege of chatting with the CEO today, Matt Hines. But on the surface, a decent result. A little mixed in terms of expectations.
Fund outflows continuing?
Fund outflow, I think they slowed, was it? Or was outflows continue or slowed?
Probably slowed.
I think it was slowing, but really interesting point there that it was, as we are well aware now, that difficult environment for these sorts of platforms just because markets have been volatile and equities haven't been quite as attractive. Answered a question really well, I thought, around potential product innovation going forward, especially if we see a very different world in terms of financial markets, which doesn't so there's constant inflow potentially into equities. He was talking about maybe product diversification there being on the agenda for net wealth to take advantage of obviously higher cash rates and these other products that investors can use now. That, you have to be a bit more discerning with your money.
Indeed. And then, did we all go to the pubs and drink lots? Endeavour Group, full year net profit 529 million versus 495, a revenue 11.9 billion versus 11.6, and they have cut the dividend. Nobody likes it when they cut the dividend, 7.5 cents from 7.7 cents. Retail sales up 2.5% in full year 24, they're flagging, and hotel sales up 4.6% in full year 24. And I don't think the market liked that result at all. Let's just check in. Yeah, down 4%.
No, sentiment's poor towards Endeavour at the moment, isn't it?
Sure is. It should be resilient in a slowdown, but
isn't there some gaming reforms though too coming through? I think it's Victoria, which could maybe take a bite out of profits. Which
absolutely,
the self-righteous person in me says, well, that's not such a bad thing for the world. But we'll get a view on that actually, because we had Michael Wayne from Medallion Wealth as well as Carl Kapelingler from Think Markets giving us their view on
it's a big black candle and a big gap, and that's where I basically have to tell anybody who follows me, okay, we're on the way out the door now. Might not be today, but we are working our way out of this. And honestly, it has not seen barely an uptick since then. It just goes to show once you disappoint the market, once you lose the faith of the market, just how hard it is to get it back. And I think we've just seen, as you say, that premium be eroded. So it was trading, not that long ago, it was trading sort of mid-20s on its PE, and that's come down to 18. Which is still expensive. It's still expensive for this type of company, which is going to deliver us all of about 4% compound annual growth over the next 3 financial years. So, your typical ASX stocks, I'm just going the average here, it's going to give you sort of 7-8% growth, and it's going to have a PE of around 15. So we're getting less than the market's growth for more than the market's PE, and that PE continues to contract. Some might say, I'd like it for the dividend yield. Well, the dividend yield is about 3.8%. It's not awful, but now below 12-month term deposit rates. Plus, you've got that awful chart, short-term downtrend, long-term downtrend. I just can't find a reason to own it right now. So if I can't find a reason to own it, I must go sell.
A 20% drop in gaming revenue for them would have a fairly significant hit to their earnings. I think some people are estimating 20 to 30%, even more. So that's something that I think the market's just been digesting as well in recent times. It's hard because the liquor business is a very mature business. Obviously, yes, a lot of the population do drink and go to bottle shops, etc., but it only really grows at the rate of population growth. And that's probably why, as Carl touches upon, the earnings growth for this business is around 4% per year. So it's nothing too exciting, and the valuation's nothing too compelling either. They've had a couple of bad updates recently, missing consensus over the last 6-12 months. So probably best to give this one a wide berth for now, and maybe focus in on it once it starts to bottom out.
So neither of the lads liked it there.
Wide berth says it all.
Yeah, I think so. Okay, well, perhaps we'll get a view from our guest about Endeavour. Just to start with, William Science from Macro Capital joins us at the desk. Will, does Macro have a strong view towards Endeavour as whether they like it or not?
Look, it's not a company that we're particularly keen on at the moment. Obviously, the report, they missed on expectations, and they've been in a pretty sustained downtrend since that profit downgrade in August. And despite that, still trading on a pretty extended PE multiple whilst delivering below average returns and growth at the moment. So definitely not a company that we're particularly keen on holding at the moment. I think also it's meant to be a defensive stock and it certainly hasn't delivered on that reputation. So until the market indicates that it's back in favour, it's not really a company that we'd be looking at owning.
And what about, so companies like Transurban today, is that one that you like? I mean, they should be beneficiaries of a higher inflationary world from the perspective of toll fees going up.
Yeah, look, it was a pretty strong report out of Transurban. Their profits certainly risen quite significantly, and they're definitely passing on a lot of the inflationary impact onto toll road users. So I think they're quite well placed at the moment. I think the key thing with Transurban is that they largely have a monopoly already, but they've lodged to bid for the Eastlink road. And so if that does get approved by the ACCC, it'll be that they own every kind of toll road apart from two, and so really securing their place as a monopoly. But if that does get knocked back, I think that'll certainly be a bit of a risk event for them, and quite possibly a bit of downside if that does get knocked back. And the ACCC has certainly been flexing their muscles a bit recently with knocking back a few acquisitions that are going to be restrictive of competition. So I think that's the key thing to watch with Transurban at the moment.
Well, Bapcor was the real outperformer. I was sort of scratching my head, and with the state of things at the moment, so hard that I almost drew blood, that the stock was up, but I couldn't necessarily see on what. I mean, how did you view the Bapcor numbers?
Look, I didn't think it was a particularly stellar result. It was largely in line with market expectations. And I think realistically they noted a number of risks that are impacting particularly that retail arm of the business. I did notice that they offset that with a few of the other divisions. But I think the highlights out of the report were that they've got greater cash conversion but also lower net debt. So they're quite well capitalised and also reasonably liquid. And I think in this uncertain economic outlook at the moment, those are quite positive things for the stock. but I'd agree. I think it was largely in line, and the market's taken it quite positively. So one of the only outperformers on their report today.
And last but not least, Dexus, because so much concern over the commercial office sector and valuations.
Yeah, look, they did swing into a statutory loss, and they had pretty significant write-downs across their portfolio, with that whole office sector struggling quite a bit at the moment. There's certainly continued pressure in that space, and valuations are expected to continue to decline. So quite a risky area to be involved in the moment. That said, in quarter two, they actually had vacancy rates ease slightly, still above the long run average, but easing. So potentially a continued effort at cutting some of the work from home arrangements. I know a number of the big firms are trying to get everyone back in office for kind of corporate culture and that side of things. But look, their guidance, they anticipated that fiscal year 24 is going to remain quite challenging for them. And I think most sentiment in that space is indicating that office is a bit of a turbulent environment to be involved in at the moment.
Obviously, it was a very broad-based sell-off, so you get the sense that it was sort of, more than just obviously company reports that were driving price action. I mean, how are you sort of seeing things more broadly at the moment? I mean, we've got the China issues. Clearly, retail sales are strong as well.
Yeah, I think the retail sales is probably the bigger issue, at least catalysing today's sell-off. They came in quite a bit above expectations, came in at 0.7% above the 0.4% forecast. And there's obviously been a lot of rhetoric at the moment about the Fed having finished and also probably heading into the next phase being cuts. But I think this retail figure has ruffled a few feathers, that we may see that flow through into inflation staying elevated for longer. And so originally, prior to that result, the analyst consensus was 116 basis points of cut next year. That's dropped down to about 106 basis points of decreases. So definitely ruffling a few feathers there. And then when you add that to the China situation at the moment, that's definitely impacting our iron ore miners, which are a pretty hefty chunk of the market.
Totally. China. It's not looking too great, is it?
No, not particularly crash hot there. The data yesterday was weaker on pretty much all fronts, and their retail sales were way weaker than expected. And so when you add all that into the deflation story, I think a lot of people are wondering why there hasn't been a bigger stimulus measure implemented. I think we've got the loan prime rate next week, and most sentiment is there for a cut on that. But I think analysts want to see fiscal measures come into play and government stimulus going to consumers to help shore up the economy there. And that'll obviously have a flow-through impact domestically. But until we get that, I think there's going to be a fair bit of downside in the iron ore miners.
Happy days, Will. Really appreciate your insights as always. Will Symes, Macro Capital. We'll talk to you again soon. Okay, let's get a look at the leaders and laggards, shall we? I think we've already spoken about a lot of the stories here. Bapcor and Mirvac up the top of the table here, and Vicinity centres too. So some of the earners today managing to sort of buck the bearishness, and
so bad they're good.
So bad they're good. There you go. Super Retail pulling over as well, higher. Let's go to the laggards now, and Fletcher Building. We noted that off the top. The disappointing results. Zero Resources. It's sort of high base miner, I guess you could say, dropping 6.2%. Brainship, always on the list, one way or the other, just very volatile. And I don't know if I can find much news around Megaport and IPH, although I think IPH might be reporting tomorrow. Although there's about, 30 companies that are, so I could be wrong.
Full on, indeed.
It's going to be a busy one. We'll get to that in a sec. But small cap leaders and laggards. What do we got there? Nothing that really jumps out to me, other than obviously just some big moves there. Laggards largely dominated there in the small cap space as well by the miners, so there's commodity names, sensitive perhaps to the China story as well. All right, what's on overnight? And UK CPI has just got released, and maybe some good news perhaps?
Well, it's in line with expectations apparently, but it's down to 6.8% in July, so I'm sure being very, very welcome indeed. So that follows on from the cooler than expected 7.9% that they had in June. But the trend is your friend. I think we'll take it.
Yeah, absolutely. So as Danny said there, 6.8% headline CPI for the UK. Also in the data tonight, on the data front in the US tonight, US building permits, also FOMC minutes as well.
And a couple of reports.
And
Costco?
A few reports. Costco.
Target?
No, sorry, not Costco.
Walmart?
It was Cisco.
Cisco,
which is another sort of big one, just in terms of obviously the tech story. So we'll keep an eye out there. But this is tomorrow. Obviously, this isn't a full and exhaustive list of the companies reporting tomorrow. You know, there's about 2 dozen that are. But amongst them, ANZ will provide a quarterly update. ASX, Evolution, Sonic, Telstra, Domain Group. Those are just the ones that caught my eye. There's, again, a stack more. I don't know if there's anything that's on your radar by any chance.
No, not in particular. And also QBE and Centre Group going ex-divvy tomorrow.
Jobs report, that'll be interesting. We'll have Bjorn Jarvis from the ABS to come on at, a bit after 11:30.
Cool.
The unemployment rate's expected to tick up to 3.6%. A slight increase in jobs at forecast, but not enough to offset, obviously, those migration pressures, perhaps. Increased supply of labour. Other than that, I think that's be the next 24 hours.
That's it, yeah. And it looks like the ASX 200 has closed down almost 110 points, 1.5%, 7,195, and the COB 200 down 20 points, 1.44%. So I think that's enough of seeing red on screen today.
Yeah, that'll do it. We'll wrap it up. But there was a lot of good content on the website, or there is on the website.
Absolutely.
And especially if you're interested in some of those earnings results, there's going to be plenty more of it tomorrow. So perhaps you'll have to gauge yourself for that. But in the meantime, have a lovely night, and we'll see you tomorrow morning.